All right, welcome to this explainer on a topic that is absolutely crucial for your CFA Level 2 exam, valuing bonds with embedded options. We're not just talking simple discounted cash flows here. We're diving deep into the world of callable and putable bonds. You're definitely going to want to know this stuff for exam day. Okay, so here's our game plan. First, we're going to dig into why embedding an option completely changes how we have to think about bond valuation. Then, we'll get our hands dirty with the binomial interest rate tree. That's our main tool. After that, we'll use the tree to actually value these bonds, analyze them with something called the option-adjusted spread, and finally, wrap up by figuring out how to measure their true interest rate risk using effective duration. So let's dive right in. The big question is, why does adding what seems like a simple feature, like the right to call a bond back early, suddenly make everything so much more complicated? See, this is the fundamental problem we're trying to solve. A regular, plain vanilla bond is easy. The cash flows are set in stone. But the moment you introduce a call feature, boom, uncertainty enters the picture. If interest rates drop, the issuer might just call the bond back. And those nice, high coupon payments you were expecting, they're gone. So how do we put a price on that kind of uncertainty today? So how do we actually account for this in terms of value? Well, it's pretty straightforward. Think of it this way. With a callable bond, you, the investor, have essentially sold an option to the issuer. That's a liability for you, so it's going to lower the bond's value. On the flip side, with a putable bond, you own the option. That's an asset, and it makes the bond more valuable. Now, this brings us to a really key concept. You might have heard of it. It's called negative convexity. When rates fall, a regular bond's price goes up, right? But for a callable bond, falling rates also mean there's a higher chance the issuer's going to call it back. This puts a lid on how high the price can go. It's like there's a ceiling on your potential profit, and that's a huge deal for investors. And you know what? It's not just about whether rates are high or low in general. The shape of the yield curve is also a massive factor. A steep upward sloping curve, that suggests future rates will be higher, making a call less likely. But a flat or inverted curve, that's a red flag for a callable bondholder. It implies future rates might be lower, making that call option much more valuable to the issuer, which, of course, is bad news for the bond's price today. Okay, so we've got all these what-ifs about future rates. How in the world do we model all that? Well, that brings us to our main tool for the job, the binomial interest rate tree. Okay, binomial interest rate tree sounds super complicated. I get it, but don't let the name fool you. Think of it as a map. It's literally just a map of all the possible roads that short-term interest rates could take in the future, all based on some starting point and an assumption about how volatile rates are going to be. Everything starts right here at time zero. This is today, the here and now. There's no uncertainty yet. Our starting point, the root of our tree, is just the current one-period interest rate. No guesswork, no probabilities. We can just look it up in the market. Okay, now let's jump one period into the future. From our starting point, the model says the rate can only go to one of two places, a higher rate or a lower rate. And the model assumes it's basically a coin flip, a 50-50 chance of going up or down. And if we keep branching out period after period, this is what a complete tree looks like for, say, a 3-period bond. See how it spreads out? This is our roadmap of every possible interest rate path the bond could face until it matures. All right, we've built our map of the future. Now for the fun part. Let's actually use it to find the bond's value. We're going to use a process called backward induction. The logic behind this is actually really intuitive. To figure out what a bond is worth today, you have to know what it might be worth tomorrow. So we start at the very end of the tree, at maturity, where we know exactly what the bond pays out. Then, and this is the most important part, we work our way backward, one step at a time, calculating the value at each node and checking to see if that embedded option gets exercised. Let's walk through a quick example. So, at the end, in year 3, the bond pays out $104.25. That's par plus the final coupon. We take that amount and discount it back 1 year using the different possible interest rates at each year 2 node. That gives us these initial calculated values, 98.5, 99.5, and 100.5. But wait, we have to remember this is a callable bond, and the call price is 100. So we have to check our work. At the top 2 nodes, the values are below 100, so the issuer wouldn't call it. But look at that bottom node. The calculated value is 100.5. Now, if you're the issuer, what are you going to do? Of course, you're going to call it back for 100. So the value can't be 100.5. It gets capped right at the call price of 100. This decision at each node is the absolute key to this whole process. Okay, so we've figured out how to get a value for the bond using the tree. Now let's introduce a really powerful metric that helps us compare these things, the option adjusted spread, or OAS. So what exactly is the OAS? Think of it like this. You have your interest rate tree, and you have the actual price the bond is trading for in the market. The OAS is the single constant spread, the magic number you have to add to every single interest rate on your tree to make your valuation model spit out that exact market price. It's stripping out the effect of the option and telling you what spread you're earning for credit and liquidity risk. Now, for the exam, this is what you really need to know. You use OAS for relative value. It's a simple rule of thumb. If you're looking at two similar bonds, same credit quality, same maturity, the one with the bigger OAS is probably the cheaper one, the better deal. A smaller OAS suggests you might be overpaying. Okay, this next point is huge, and it's a favorite for exam questions, so listen up. For a callable bond, what happens when interest rate volatility goes up? Well, think about it. More volatility means more uncertainty. For the issuer who holds the call option, uncertainty is a good thing. It increases the chance they'll get to call the bond at a great price for them. That makes the option more valuable. And since you're the one who sold them that option, its higher value comes right out of your pocket, which means your OAS has to go down. Higher volatility, lower OAS for a callable bond. All right, we're on the home stretch. We figured out how to value the bond. We know how to compare it using OAS. The last piece of the puzzle is measuring its risk properly. And here's the bottom line. For these kinds of bonds, your old friend modified duration just won't cut it. Why? Because modified duration assumes the cash flows are set in stone. But we know for a fact that with a callable bond, the cash flows change when interest rates move. That's why we absolutely have to use effective duration. It's the only measure that gets it right. The process for calculating it is very systematic. First, you find the OAS that matches the bond's current market price. Then, you do a little experiment. You shock the entire yield curve down by a little bit and revalue the bond. Then you shock the entire curve up and revalue it again. The absolute key here is that you use the same OAS you originally calculated for all three valuations. That gives you your three price inputs. And once you have those three prices, the original price, the rates down price, and the rates up price, you just plug them into this formula. What this tells you, in plain English, is the percentage change in the bond's price for a small shift in the yield curve. It's our best, most accurate measure of interest rate risk for these tricky securities. So what's the big takeaway from all this? It's that for bonds with embedded options, your standard toolkit just isn't enough. You have to go deeper, using tools like interest rate trees, backward induction, and effective duration. This whole framework shows us just how much the simpler models can miss. And it really makes you think, doesn't it? If these hidden risks are lurking in callable bonds, what else are we missing in the even more complex financial instruments out there today?